So we'll begin our last session of the conference. We're happy to have Tong from Barclays present a paper on analyst stability for 20 minutes, followed by Don's discussion afterwards. Thank you.
Hi. First of all, I would like to thank the editors for this opportunity to present our paper at the RAST Conference. And I also would like to thank Dole for agreeing to be our discussant, and we look forward to your comments and suggestions. And this paper is co-authored with Peter Pope, and I believe he's sitting somewhere in the audience. And this paper is largely completed. I was a PhD student in finance at Bocconi. So before my job as a portfolio strategist at Barclays. And yeah, I realized like I stand between you and lunch and perhaps your holiday shopping. So if there's no further ado, I'd better get started right now. So the title of the paper is Analyst Ability and Research Effort, Non-EPS Focus Provision as a Focus Quality Signal. And our research question can be summarized as, does the number of financial statement line items forecasted by an analyst signal her research quality? And we find that within firm years, the number of forecast types, so NFTs, not non-fungible token, issued by an analyst explains the differences in their earnings forecast accuracy, price target forecast accuracy, and stock recommendation profitability, and the capital markets reactions to stock recommendation revisions. And also, the number of forecast types issued by an analyst predict their career outcomes. And our results are not driven by a single forecast type like revenue forecast or cash flow forecasts. And the main takeaway of our paper is NFT is a parsimonious measure of an analyst's research ability and effort at the firm year level. And it is available for all analysts, old and new, and for all firms. And it doesn't require a long time series of data to estimate. So our work is motivated by the expansion of the number of available forecast types in IBES. So the figure on the top shows that the average number of forecast types in IBES provided by an analyst has increased over time, and especially for forecasts with a horizon greater than 1 year. And the figure on the bottom shows that the increase in the forecast types exists in all financial statements, including income statement, balance sheet, and cash flow statement, but particularly for income statement. But the increase in the number doesn't necessarily imply the within firm variation, but this figure confirms the considerable variation within firm year in terms of non-EPS forecast provision. I'm sorry for the very busy figure. So the green bars represent the within firm year range of the number of forecast types, and the lines represent the interquarter range. So we can see the considerable variation across analysts in terms of providing forecast types, and the within firm year variation actually changes over time, and the change in within firm year variation are particularly larger for longer term forecast types. And to have a better understanding of the source of the variation, we look into a snapshot of forecast coverage and provision in the year of 2020. So the first column shows the percentage of firms with the related forecast coverage, and the second column shows within those firms the percentage of analysts who have issued at least one related forecast. For example, if you look at the second row, in the year of 2020, only about 56% of firms had cash flow forecast coverage, and within those firms, only about 34% of analysts issued at least one cash flow forecast. So many analysts choose not to forecast many of the line items. And while for other forecast types like revenue or sales forecast on the last row, almost every analyst issued revenue forecast in that year. So there's very low cross-sectional variation within firms for some forecast types. And so our observation actually is consistent with the statement in Bear et al.'s literature review paper that this decision to forecast or provide only a subset of firms' fundamentals is even more puzzling given the recent findings that analysts rely on some of these measures to forecast others. And our paper is based on the stream of literature focusing on in the non-EPS forecast provision. So the prior literature examines the relevance of individual non-EPS forecast type provision, like cash flow forecasts, and also for sales forecasts and long-term earnings growth forecasts. And most importantly, two more recent papers by Bielinski and Han et al. Document that investors react to a large set of analyst forecast surprises far beyond EPS forecast or cash flow forecast or revenue forecast. So our predictions are developed based on the argument of benefits and costs of providing non-EPS forecasts. So we have empirical evidence that investors demand a broad set of forecast types. And also forecasting a full set of financial statement line items can facilitate analysts' understanding of firms' operating, investing, and financing activities. However, providing a full set of financial statement line items is costly because that increases their task complexity and their research effort. And the cost is particularly high for less capable analysts. And also, providing more forecast types increases analysts' exposure to ex-post monitoring of their research quality from buy-side investors, brokerage firm management, and analyst rating agencies. So our predictions can be stated as follows. More capable analysts and those expending more effort are more likely to provide non-EPS forecasts. And a greater range of forecast provisions signals analysts' ability, effort, and confidence in their research. So the research design is as follows. So the variable of interest NFT number of forecast types is based on a count of analyst J's non-missing items for firm I during the past 3 calendar months prior to month T. So basically, we count all forecast types with a focus horizon from 1 year ahead to 5 years ahead, and also long-term growth. So we're not so ambitious to identify analysts of forecasting behaviors or their disclosing behaviors, but we think that's almost impossible to differentiate from the two channels. But either channel, forecasting channel or disclosing channel, is consistent with our arguments of benefits and the costs of providing forecasts. And importantly, we use within firm year standardization research design because firm fundamentals may affect analysts' forecast type provision. For example, firms with poor financial health or lower accruals quality are more likely to have cash flow forecasts. And forecasting difficulties are different from firm to firm. And as we saw in the previous figure, the number of forecast types have increased over time. So we decided to use the range standardization by Clement and Tay, and to control for all unmodeled firm and time-specific effects. So we don't need to control for firm characteristics in our research design. And also to mitigate the concern that our results are purely driven by factors at the brokerage house level, we control for brokerage house fixed effects. And even in some specifications, we control for firm analyst fixed effects. And first, we want to study what does NFT capture. So the basic idea is to regress NFT on a series of analyst characteristics. And we find that NFT is positively correlated with analysts' innate ability to move the consensus EPS forecast towards the actual. And NFT is also positively correlated with forecasting frequency, which is a proxy for forecasting effort. And NFT is also positively related to lead follow ratio, which is a robust measure of leading analysts. But we also observed that NFT is negatively correlated with consistency, which is also a proxy for analyst innate ability. So this observation shows that NFT capture and the consistency capture analyst ability from very different angles. And interestingly, analysts with less forecasting experience issue more forecast types. So this is consistent with the notion that Bayesian investors learn about analyst ability from their past performance. So more experienced analysts, their ability has been revealed by their past performance. They have weaker incentive to engage in the costly focus provision activities. And we also regress NFT on fixed effects, and the 20% of variations in NFT can be explained by brokerage house level factors, but only to a limited extent. And if we regress NFT on analytic fixed effects, we can see that the variation across analysts is substantial and not fully explained by brokerage house. And if we regress NFT on firm analyst fixed effects, the adjusted R-squares is as high as 50%. So analysts selectively provide more focus for some firms in their portfolio. And interestingly, firm analyst fixed effect is a proxy used by the prior literature as a measure of analyst innate ability. So NFT captures analyst innate ability pretty well. And our first set of results look into the association between NFT and EPS forecast accuracy. The dependent variable is mean adjusted earnings forecast error. And as we can see from column 2, after including brokerage house fixed effects, on average within firm year, EPS forecasts accompanied by more forecast types are 4% more accurate relative to the consensus. And in the third column, we include firm analyst fixed effects as a proxy for analyst innate ability, and our results still hold, and which indicates that when analysts provide more forecast types, their EPS forecasts are about 2.4% more accurate. So analysts strategically using signal their superior research quality using non-EPS forecast provision. And our second set of results look into price target accuracy. And the second column show that on average within firm year, price targets accompanied by more forecast types are about 1.2% more accurate relative to the consensus. And the results are even stronger after controlling for innate analyst ability. And next, we look at stock recommendation profitability. And on average, within firm year, stock recommendations accompanied by more focus types are about 2.6% more profitable per year. And the results are robust to controlling for innate analyst ability. And for NFT and capital market reactions, the variable of interest is the interactive term between a recommendation revision and NFT. And we also control for many concurrent revisions, like APS revisions, earnings before in tax, and the pre-tax earnings and the revenue. And we find like higher 3-day abnormal stock returns for recommendation revisions accompanied by more focus types. And the effect of NFT is robust to other concurrent focus revisions. And stock recommendation revisions accompanied by sales forecasts are more influential. So this is an extension for Quinn's results. And finally, we look at NFT and analyst career outcomes. So we look at 3 career outcomes: termination, promotion, and demotion. And Career termination is less likely for analysts who provide more forecast types. And promotion is more likely for analysts providing more forecast types. And also the issuance of long-term earnings growth forecast is also negatively associated with career termination. So this is consistent with the prior literature. And the association between termination and the issuance of the sales forecast like disappears after controlling for NFT. So let me conclude our paper. So we provide a potential explanation for analyst heterogeneous forecast type provision to IBES. And it could be a signal for analyst research ability and effort. And NFT could also reflect analysts' confidence in the quality of their research on the firm. And we find that analysts who provide more forecast types relative to their peers are better EPS forecasters, better price target forecasters, better stock recommenders, and they can generate stronger capital market reactions, and they have more successful career outcomes. And NFT as an ex-ante measure of analyst forecasting performance doesn't need a long time series of data, and it's useful to identify high ability new analysts, and it can be applied to most firms in the IBES universe. And the future research on analyst non-EPS forecast provision could consider the interdependence between different forecast types. Thank you very much.
Okay, well, thank you so much. It's a pleasure to be here, and thank you to the conference organizers for inviting me to do this discussion. I wanted to recognize the fact that I think this is the first conference I've been at where over half of the discussants were women. So, you know, kudos to the organizers, you know, high marks for DEI. Okay, so and before I start, I do want to recognize 5 of our PhD students at the University of Washington: Mallory Bennett, Andrew Glover, Jake Everhart, Carter Sampson, and Ruth Senior. And it's just because when preparing for this, I was teaching a PhD seminar, so I gave it to them, and they were helping me to like sort of think about what to talk about. So I did tell them if this goes south, I will throw them under the bus. So hopefully that won't happen. Okay, so we're going to talk today about NFTs, but not those type of NFTs. We're going to be talking about the number of forecast types that are reported on IBES and their association with a number of outcomes, right? So we have EPS forecast accuracy, target price forecast accuracy, recommendation profitability, market reactions, and career outcomes. And so what, you know, one of the things I think Tong talked a little bit about what these non-forecast or number of forecast types represent. So there are a number of sort of non-EPS forecasted items on IBES, which I actually wasn't aware of, that there was such a wide number of different types of items that are forecast. Some are income statement items like EBIT, EBITDA. Some of them are cash flow items. Some of them are balance sheet items. And those are the most surprising, that I didn't realize those were there. And they can be for different horizons, right? 1 to 5 years or long-term growth forecasts. And they're just kind of aggregating all of that. So as an example, I should point out that there are papers, right? We know about some of these forecasted items: sales forecast, cash flow forecast, CapEx, and long-term growth, that people here in the audience have studied, and maybe should be doing this discussion, but no, I'm here. Okay, so there have been, you know, so I was kind of looking at some different analyst reports just to see what, you know, what these reports kind of look like and what might be on there. And I did find this report for analysts covering Microsoft, and you can see that they do forecast a number of different things. And they do it not just for the upcoming year, but for like 2 or 3 years out. And so this would be, I think, an example of a report that would have, you know, a high number of that NFT measure. And as Tom pointed out, this NFT measures by growing over time, like the number of forecasted items has been increasing, and it's not in any one category. As he pointed out, that it's not just 1 year ahead. So this is 1 year ahead. These are income statement items. These are balance sheet items, cash flow items. I changed the scale here so you can kind of see that the trends are very similar, right, in terms of the increasing availability of these forecasts. Okay, so I want to spend most of the time here kind of talking about the framing of the paper, because I think that was the part that I struggled the most with when reading the paper. Basically, sort of this, whether the paper is really about this measure and its predictive value, or whether you're trying to tell a story of some sort about how analysts forecast and distribute their forecast on IBIS. I would also point out that I think the first 4 items are very similar in terms of kind of measuring the quality of the analyst forecast outputs. The market reactions is maybe slightly different in that it's like kind of a perception of their output, the quality of their output. But this career outcomes, I think, seems a little bit different. It's like the outcome of having high quality other outputs, right? So it seems a little bit different in that respect. So I'm going to kind of focus more on these other 4 and talking about this. I would note that the empirics have a lot of really nice features that really strengthen, I think, what this association is showing. So this NFT measure is measured with a lag. So it's not like the analyst, like in that analyst report, they issue a whole bunch of things and that forecast is accurate, right? They're measuring the number of items they forecasted in the past and seeing whether their future target price and earnings forecasts are more accurate. And there's lots of control variables that they include. And as Tong talked about, the forecast errors are mean adjusted within a firm year or firm quarter. So it's really measuring, comparing like within this firm's, what's happened to the firm this year, how different analysts are performing. And then in some of the specifications, they are including firm analyst fixed effects. And I think that's important because it's like they're comparing, for a given firm analyst pair, variation across time, right? Okay, so I'm going to talk about like 2 potential stories here. And I think Patty, at your presidential address in August, you talked about how accountants like stories. And that's true. Like, I like stories. So I'm like, what is the story here? So here's 2 stories. One story is that more diligent analysts, forecast more of these items, right? And that makes their outputs better. Okay, that's one story. The other story is that there's more informed analysts, and these analysts have better outputs, and so they report more of these items in order to signal that they have better information. So it's not that the actual forecasting itself is helping them have better outputs. It's just that they have better outputs, and so they sort of signal that, right? So I think that the one story is like the quality improvement story, and the other one I'll call the signaling story. And this quality improvement story, I would say, is maybe a little more consistent with the Call et al. Paper that looks at cash flow forecasts, where they're kind of saying forecasting cash flows kind of helps the analysts be more disciplined about their earnings forecast, so their earnings forecasts are more accurate. Whereas the signaling story I see is more like the Ernemer et al. Paper, where they're looking at revenue forecasts and saying, all analysts forecast revenues. It's just some of them report them because they want to, signal that they're better analysts. And so I think right now the paper, you recognize, right, that it's hard to distinguish forecasting from reporting. And so we don't really know which one it is. And so maybe it doesn't matter. So so one thing I think is that in the paper, you talk a lot about effort and ability. And so I see and kind of together, right? So I see effort as being kind of more with this quality improvement story, whereas ability is more of this signaling story. But part of the problem is that you're controlling for this firm analyst fixed effect. So you're kind of controlling for this innate ability. So it would have to be some kind of time varying ability. And that's harder to figure out, like what that is, right? What this time varying ability is. So I think the thing is right now, you're just saying it doesn't matter, right? We're just going to, these 2 things are associated. One predicts basically this lagged NFT measure predicts research output quality. And so that's kind of the focus of the paper. So I think that is sort of a different framing, right? It's just sort of, we're going to say that this is a better measure than for predicting research output quality. And so when I read that, this better measure thing, I immediately think, oh, this is a horse race, right? We're going to like benchmark this measure against other measures. And there is language in the paper where you talk about how this measure is better than other measures, right? In terms of there's better granularity. It's not just a 1-0. There's greater within firm variation. It's not like revenue forecasters, like everybody forecasts that, so there's more variation, and it doesn't require such a long time series. So there is language in there that makes me think that that's the point of the paper, right? Is to show that there's this predictive ability. But then I sort of thought there would be some comparison of this to other measures. And although you have control variable, like you put some of these in the regression, you're not measuring it over the same time period, right? So it's not really like a horse race. And it's sort of incremental, like it's incrementally predictive, not on a relative basis. So I kind of think of our, when we talk about incremental information content and relative information content, like, should we be doing more of a relative comparison in order so that we can, crown a winner, right? There's a winner to the horse race, or it's probably, I guess like overall, I just think that there needs to be more discussion. Why is this predictive value useful, right? Why would we want to be able to predict this? And is it so that we can sort of construct a better consensus or have some kind of trading strategy? And I think in the prior version, you had something that was like a trading strategy, right? But I think the current analysis of recommendation profitability is not a trading strategy because you're standardizing it. And so you need future outcomes in order to come up with a standardized measure. So that's sort of not in the paper, right? But I think there has to be I think more of a discussion of why we want to be able to predict analysts' ability, right? And so in that regard, I think this career outcome seems a little bit out of place in the sense of like, why do I want to be able to predict the analyst being terminated or not? Is that important to know that? I don't know. Maybe not as important as these other things, right? Of having like being able to make money. We don't want to make money. Right? Okay. But I still come back to this because I'm an accountant and I like stories. So there is a part of me that keeps wondering, like, which one is this, right? What is going on here? And in particular, is it forecasting more of these or is it reporting these, right? And I kind of wish we could figure that out. I know that it's really hard, and to be honest, I spent a lot of time thinking about this and I couldn't come up with a really great way to do this. But I do have some suggestions. So some lingering questions, right? Do all analysts forecast these metrics, but only some of them report them to IBIS? So, one thought is that you could just gather a small sample of research reports and try to see if they match to IBIS. I think in the Erdem et al. Paper, they do that with some of the revenue forecasts, right? Just to see if there's like, you take 50 or something, provide some sort of anecdotal evidence on that. It also occurred to me, like, in terms of like this quality improvement story, some of the metrics seem like they might be more relevant for forecasting earnings, and then some of them seem like they're more relevant in some kind of valuation sense. So they would be perhaps more useful for like a forecasting target price or this recommendation profitability. So maybe you could somehow divide that in some sense. And then there's some metrics that are in there that seem kind of superfluous, like they wouldn't really help improve accuracy, like EBITDA per share. When you have EBITDA, like having EBITDA and EBITDA per share doesn't really help, or having net income when you have EPS, maybe that's not as important. And even GAAP EPS, I do kind of wonder, like, if you're trying to forecasting GAAP EPS might not be that useful if you're trying to figure out like sustainable earnings that are going to determine like valuation. Okay. And then the other thing I think is that this idea that you're doing this within a firm analyst pair, I just really wondered, like, what is causing this variation? Because it's not this ability, like it's not innate ability, right? So there's something that's varying over time. And I don't know if there's maybe like uncertainty plays a role somehow, like where, if there's greater uncertainty in this quality improvement story, maybe the more diligent analysts will have more of these forecasts. They'll have to do a better job of forecasting these items. Whereas from a signaling perspective, there's more uncertainty, I'm less informed, so I'm not going to signal that by disclosing more NFTs. And then I also did wonder about like coverage initiation. The only reason I thought about this is because when I pulled up that example, that was an example of an analyst that was initiating coverage on the firm. So they had a lot more of these items that they were forecasting. So maybe analysts provide sort of more robust analysis upon initiation. And we know that initiation is related to more accurate forecasts, right? So you might want to try to recalculate that MT without these coverage initiations. And then, you know, there's still this trend, right? And I don't think the quality improvement story or the signaling story explains this trend, right? Because like it's not clear why like signaling has increased over time, or you know, like somehow analysts all of a sudden want to do a better job. So it does make me wonder if there's some kind of role of IBIS, right? There's something going on there. And I know you had pointed me to that Amaran et al. Paper that kind of looks at this other product that IBIS has, called TR Research, where they distribute the reports through to clients. And it's possible that there's something going on there there's some contract between IBIS and these other institutions that are allowing certain analysts to have more of these, greater number of these forecast items on IBIS. So I don't know if maybe you do control for broker effects, maybe broker year fixed effects would kind of address any broker specific contracts that they might have with IBIS in a given year. Okay, so in conclusion, you know, I think the paper is super interesting descriptively, especially it broadens the awareness of this wide array of different metrics that are on IBIS. And there's some super interesting trends and distributional properties of these. I think, and you have a strong association, right, or prediction of this NFT with these other outcomes. And I just think that framing it in a certain, like in a way that would kind of help the reader understand, is this just about the NFT's predictive ability, or are you trying to say something about the forecasting disclosure process, right, of analysts? And if you could clarify that, I think it would help the reader to sort of know what the big punchline is for the paper. Okay, thank you.
Thank you, Don. You want to go back up? Questions? You want to go back up? All right, we'll open up the floor for Q&A. Over here. Yeah.
Thanks. So I just had two quick comments. The first one was, in terms of the effort story, I know Ji Da and his co-authors, they have this paper where they look at how long analysts are logged into Bloomberg. So if you can, maybe it would be worthwhile to contact him and to see how much it correlates with sort of their login times to get a sense of effort. The second comment was, I come from, maybe it's a different story, but come from sort of a very behaviorally biased point of view. So if they have lots of forecasts, they may feel less attached to each individual forecast. And if they feel less attached to each individual forecast, then you might see less confirmation bias, in the sense that they might be sort of less attached to their earnings forecast and better able to adjust it. So we know that we see sticky forecasts in short-term earnings forecasts. And this can be attributed to different models, but it would be interesting to see if you use things like Koivin and Gordonachenko regressions, where you look at, do they underreact, do they overreact? If you see sort of less underreaction at the short-term earnings forecast level when they have more forecasts, that would be consistent with a confirmation bias story, and it might be something you want to look into.
Well, thank you for your suggestions.
All right, over there, please.
Thank you. Thanks, Laura from UIUC. I have a quick question on the signaling story. So I have a hard time understand why the signaling story would work. So for signaling to work, that would require the low ability analysts to have less incentive or no incentive at all to reveal their detailed forecast, assuming they also have detailed forecast. So I think what you're suggesting in the paper is that if I review all of my line items, then maybe they will see, even when I'm correct, that I actually just accidentally, luckily to be correct, actually have two errors and they cancel out each other, and now I am correct. That is true. However, I can also see their benefits of revealing my detailed forecast, right? I always tell my students in their final exams, show your work because you're more likely to get partial credits. So is it the following scenario also likely that I might got the bottom line wrong, but that's because, I couldn't figure out tax. But see my sales forecast, my margin, my turnover are awfully close. Wouldn't that actually be a good thing especially if, I'm not sure about, I understand a particularly really volatile item. I think it's actually in the benefit of low ability analysts to show their work.
Well, thank you. It's a very interesting point. I think there is empirical evidence by Cole et al.'s RAST paper that the accuracy of cash flow forecast affects analysts' career outcomes. So I think if they reveal more forecast types, it's kind of, although they show more intermediate steps, but the quality of the intermediate steps can lead to career termination, I think.
All right, anyone else? Let's go over there. Over there.
Hi, this is Kyle. I'm a student in Stanford, and I was hoping you don't mind me asking just a couple questions. The first question is building up on, I guess, Don's discussion on the signaling versus the effort story, I guess, and I'm wondering on how that would work out on the investor side as well. For instance, like, do investors take these additional forecasts as merely as like a signal of the analyst's quality, or is it something that really actually helped them in terms of valuation? And I was wondering what your views are on that. And my second question is how these. So if an analyst starts providing these additional forecasts, I'm wondering what the response is from other analysts following the same firm is. So if it's a signaling story, maybe it would prompt like a stronger reaction from other analysts in the sense that without those additional forecasts, they will now be labeled as a low quality analyst. So I'm wondering if that's something you've taken a look.
Hi, thank you for your question. I didn't understand your first question clearly. Could you please repeat your first question?
Sure, sorry about that. My first question was, so I guess from the investor's perspective, like these additional forecasts, are they just kind of like signals that they use to determine the quality of the analyst, or is it something that they actually use to yield better valuation? That was my question.
So you're asking, do investors value the additional forecast types?
Yes.
Yeah, we have results about stock market reactions to analysts' recommendation revisions. So investors react more strongly to those focus revisions accompanied by more forecast types.
We'll go over here. This is Mike.
Hi, this is Brandon Gipper from Stanford. So I thought the career outcome results are pretty interesting, but I had a question about what role do the brokers play in deciding the career trajectories of their analysts. And so one of the things that I was wondering about that was you showed the R squareds across various types of fixed effects, but if you do like a broker firm fixed effect, what sort of incremental R squared would you see for the analyst? Like, does it seem as though the analyst incrementally does additional forecasts above and beyond what a broker firm coverage decision would want to be for that firm? And then the other question that I had was, with these career outcomes, does it seem like they're happening within brokers or across brokerages? And yep, you're gonna go ahead.
I would like to answer your second question first. So in the career outcomes tests, we include brokerage house fixed effects. So I think the effects are within brokerage. And your first question, I'm sorry?
So my first question was related to is the coverage decision of the broker, I would guess, but you can correct me if I'm wrong because I'm not super familiar with the institutional details here. So if you did broker firm fixed effects and then measure the incremental R squared from the analyst fixed effects, that would seem to show something about the analyst's decision to go for more forecast types. And so I was wondering like how much you would see additional R squared from that analyst fixed effect.
Analyst fixed effects. So I didn't use, we didn't use of brokerage house year fixed effects. We use brokerage house fixed effects. And when we include analyst fixed effects, the adjusted R squares is higher.
Sorry, I'm not explaining it well. So brokers, do they play some role in choosing which firms should be covered?
That's a good question. My conjecture is yes.
And so it seems like they would also take some role in deciding how much coverage, like how much to forecast about that firm, right? So we don't want to just provide an analyst report to our customers that just have EPS. We also want to provide an analyst report to our customers that has sales forecasts as well. And so a broker might say to its analysts, hey, could you also include sales forecasts for this set of covered firms? And so a broker by covered firm fixed effect would absorb that type of variation. And then the incremental R squared from the analyst fixed effect would show, does the analyst above and beyond what the broker is wanting them to do and wanting them to cover, showing how much they're varying the amount of information they provide. Does that make more sense?
Yeah, I think we will look into that. It's a really good point. I think we haven't tested brokerage year fixed effects or brokerage firm fixed effects. I think we should include brokerage firm fixed effect to see what happens.
Yeah, it's just a question about does the brokerages make these determinations about how much coverage there should be and how much additional information should be provided?
Yeah, we don't know. We need to test.
Okay, thank you.
Michael Jung, University of Delaware. So I feel like there's a lot of accounting in this paper. You know, all the NFTs are accounting numbers. And I think it's debatable how much accounting knowledge the average analyst knows. There's probably a lot of variation. And to tie it to two other papers, I think Stephanie mentioned that it's debatable how much tax information analyst knows. And if you look at Laura's paper, for high-skilled job postings for analysts, I would contend that strong accounting background is not at the top of the list for qualifications. So I'm just wondering if maybe you're picking up not analyst ability in general, but analyst knowledge of accounting. And that's just one comment. And then I noticed in one of your tables, I think it was table 4, that NFTs is not associated with all-star status. So I just wonder your thoughts on whether you are focusing a little bit too much on their accounting knowledge, not on other qualities that analysts need to be strong in.
That's a very interesting point. Yeah, I think is accounting knowledge part of if an analyst has better understanding in accounting, can we say that analyst is more capable or has higher ability?
Survey evidence.
You're asking this room?
Thank you.
Next question, Charles.
Okay, I have a question. So it has to do with the trading strategy. So from what I heard from Don, that you might have had in an earlier draft, the trading strategy based on this. And I was thinking about when I see trading strategy results and when I don't at conferences. One is the supply side censorship. The other one is demand side censorship. So yeah, I was thinking, well, it depends on the journal, but this journal would not have a problem with that. And then I thought, well, maybe it's the self-censorship by the authors, but then one of them runs a quantitative portfolio group. So I'm trying to figure out why that was not there. And on a related basis, and more related is I didn't know how the timing of that strategy would play, the way you have these things measured. Because NFT, I think, is an annual measure, right?
It's monthly updated.
Okay, then the thing I'm a little worried about, if you're really going to do it in real time, is whether these strategy, this might be a proxy for, let's say, nearness to the realization date. So in other words, staleness issue. So in other words, let's suppose I'm just making it up, but let's suppose the NSF availability becomes more as you get closer to the date of the whatever target date you're aiming for, whether it's an earnings or something like that. Then if you have a higher NFT, it might be that your forecasts are just closer to the date of the realization or something like that. Walk down, you mean like your walk down? But yeah, what you mean distance from the date of? Okay, well then.
The first question about a trading strategy. So there's no tradable strategy because NFT is measured using information from the future, because we compare actually the number focus type within the firm year. So we're
within the same year, and then you don't implement the strategy in T+1.
Yeah, we can modify the measurement of NFT. For example, we can use like lagged. So basically, it's a range transformation. So it's like the denominator is the max minus mean. So the max minus mean can be taken from so the previous year's average. So in that way, we can have like tradable strategy.
It's the standardization. Is that the standardization? So they standardize the NFT measure using, I guess, future like other firms, I guess, that have. Is that right?
Isn't that? I mean, can you still talk about accuracy? I mean, you're using data after the realization of some of these things that you're trying to forecast, right?
For
accuracy. Yeah, like forecast error accuracy as a function of NFT. If I understand right, NFT is measured, some of it even after the realization date.
No, sorry. So the problem is standardization uses future information, but the raw non-standardized NFT itself doesn't contain future information. So we only use the number focus types prior to the event month. For example, if today we have a price target forecast, so today is 16th, we only use NFT for November.
Oh, I see. So there's no peek ahead on the NFT.
No.
So then why wouldn't you be able to do a trading strategy?
About the standardization uses future information. So NFT is a relative measure within firm year. So
your standardized. Maybe we can talk about this later, but it seemed like it's a very easy thing to shift it to a no peek ahead result, right?
Yeah, we can definitely modify that.
All right. Well, thank you, everyone. Please give a round of applause to Don and